Hey everybody, Ray Parman, Life Insurance Sales Manager with Gordon Marketing, and I'm here today with my good friend again, Paul Bechtold, who's our RVP and Debt Elimination Sales Manager. And today we want to talk to you about a very, very hot topic. It's this recent banking crisis that I think we've all seen on the news, and a lot of good information to be shared today. So Paul, can you kind of bring us up to date on some of these current events? So what's happened? I know like the Silicon Valley Bank out there on the West Coast ran into a little bit of a financial issue a couple weeks ago, and I wanted to see what you had to say about that.
Well, it was indeed a little bit of an eye-opener, Ray, and it forayed very nicely into this episode of Selling Life and Annuities. And in particular, I started looking at some of the factors around. First of all, you probably saw the videos on TV of people lined up down the street hoping to get in line to get their money back. The thing that really got my attention is how many depositors at that bank, Ray, had over $250,000 on deposit at a bank. And I'm just sitting there scratching my head thinking I should get a plane ticket and fly out to California and show them a much better place to keep their money. Because, I mean, at $250,000, they've exceeded the FDIC protection limit, right?
Yes, sir.
And I'm thinking, well, gosh, you could lose a part or a lot of your money depending on how much you had on deposit.
Yeah. Well, and just, a basic question there too, Paul. It's just, why wouldn't the bank, or why did the bank, or how did the bank lose its ability to give the money back to their clientele, their customer base?
Yeah. So that's the first question that comes obvious and springs into somebody's mind is, well, why can't they just pay them back?
Mm-hmm.
Okay. You have to understand how banking works, folks, and that is this, okay? When people bring their money into the bank doesn't hold on to the money. The bank immediately lends that money back out to leverage it. There's something called fractional reserve lending, where for every dollar deposited, they can lend out another $9 along with that original dollar, okay? They depend on not everybody coming back to the bank at the same time, like what happened at Silicon Valley Bank, okay? Banks keep money in motion. They don't leave money sitting still because they put that money to work. They're going to make it. Now, to be fair to Silicon Valley Bank, they were paying much higher interest rates than most banks, but I know my own personal checking account still pays 0.01% interest, right? So obviously they're lending that money out at a much higher rate, okay? And it's a cash flow game. It's just a simple matter of what we have out versus what we get back. What caused the banks to fail in this case is that when interest rates were suppressed so low, they had to buy long-term treasuries and bonds that once interest rates rose, fell in value, right?
Yep.
So then they had to sell that bond portfolio at a loss, and now they got a cash flow or a cash crisis on hand to be able to meet their financial obligations.
Yeah. Well, I think the Silicon Valley Bank, they were like the 16th largest bank, if I'm understanding things correctly. But that begs the question, I mean, could this happen to other smaller banking systems out there?
Well, as you probably saw in subsequent news episodes, that you saw other banks that were similar or smaller in size that did, in fact, have the same issue and crisis. And again, the government had to come in to bail them out. But what people don't realize is this, okay? A bank like Silicon Valley Bank is only required to keep 10% of cash on reserves within the banking system, okay? What people don't also realize is there's this other financial institution called an insurance company, and in the case of whole life insurance companies, they have to have a dollar for dollar match on reserves, or at least very close to that, because there are guarantees that they have to be able to support within those insurance contracts, okay? And with whole life insurance, they have that guaranteed death benefit that we have to be able to pay out should we get into a similar kind of crisis.
Yeah. So, these banks, there's a lot of turmoil. There's a lot of questions out there. Paul, what could be a better alternative for somebody who's wanting to put their money somewhere?
Well, that alternative would be a dividend-paying whole life insurance contract. And let's kind of rattle down through what some of those better factors are going to be. The first thing is I'm going to be at an interest rate instead of 0.01%, something in the 4 to 5% long-term growth interest. Okay. The second thing is, let's just say Silicon Valley Bank was paying 4 to 5% in interest. Every year, you're going to get a 1099 for the interest gain in your account. There is no 1099 with an insurance company. That money's all growing tax deferred,
Yep.
right? Okay. Yep. The third thing is that if somebody passes away with a bank account, they get the value of that account. That's all they get. So obviously, being a life insurance expert yourself, Ray, you know that with a life insurance policy, they're going to get 2, 3, 4, 5 times that account balance.
Oh yeah,
as well, right?
Absolutely.
Also, that's the death benefit, and that death benefit can turn into other financial benefits like living benefits, critical illness, chronic illness, etc. But then there's also better protection. You have an agreement between you and the insurance company that nobody can come in and invade. So it's protected by contract law. So there's a whole host of reasons why you want to start keeping less money in this bank over here and start putting more money in this bank over here, i.e. a dividend-paying whole life insurance contract, because of those added financial benefits and protections.
Oh, yeah. Well, there's a ton of people using this. I know, with a lot of the debt elimination programs that you interact with. I mean, can you briefly describe, how people are benefiting from going the life insurance route rather than just relegating themselves to, throwing money into a bank?
Well, let's use a couple famous families, the Rockefellers and the Rothschilds. Okay, the Rockefellers and Rothschilds realized this 150 years ago with far inferior products, and also, by the way, lifespans that were far shorter than what we had today. But they immediately saw how storing your money inside of a cash value life insurance policy like this that was properly structured and be able to put the money in, grow and compound their money, but then take the money out and leverage for use and control within their own families and create generational wealth across multiple family members. Folks, we can do the same thing for you and your clients as well. Okay. I do this in my household. Okay. I have several policies between my wife and I. I leverage this very same concept. So I am eating my own cooking. I am doing exactly what I profess that the average American out there does, and what I'm suggesting that you do for your clients as well.
Yeah, I'm just surprised more people don't do this. I mean, is it kind of more of a, hey, the general public just doesn't know about this kind of concept or how cash value life insurance really could work for them aside from just the death benefit?
Well, a lot of it is an educational thing, but there's also people out there like banks that don't want you to know anything about this concept. But the ironic part of that, Ray, is, as you know, the biggest holders of these kind of life insurance policies are banks themselves.
I was just going to mention that. Yes.
Yeah. So in their tier one assets, even above their buildings and real estate holdings, properly designed what they call investment grade life insurance contracts are one of their top tier one assets. And they learned this trick a long, long time ago. And ironically, those two families I was talking about, the Rothschilds and Rockefellers, they both happen to be in the banking business, right, Ray?
Yes, they did. How about that? Funny how things work out like that. But I'll tell you what, that's some phenomenal information that you just shared there, Paul. And, if any agents or even any buddy that's out there, tuning into this channel want to learn more about this concept and how to help their clients, where can somebody contact you at, Paul?
They can contact me at paulgordonmarketing.com. I'm also a 24/7 guy on my cell phone, so 317-626-3054. Love getting calls. I especially love getting calls about this concept and somebody getting excited about getting out of debt and freeing up their cash flow and creating massive wealth for them and their family, and passing on massive generational wealth as well.
Yeah, absolutely. There's just so many opportunities that can be bred out of this type of sales process there. So, but with that said, Paul, we are about out of time for this episode of Selling Life and Annuities. For those tuning in out there, again, make sure you hit subscribe, hit that notification bell every time we release a new episode. You'll be notified about that. And don't forget to like, comment, and share. So again, thanks for tuning in, everybody. For Paul and myself, Ray Parman here at Gordon Marketing. We will catch you on the next episode. Happy selling.